Good afternoon, everybody. Thanks so much for dropping by. I hope you're all doing well, even though it's a little rainy outside today. Today, we are really excited to welcome Karsten from the Bishop McDonald Advisory Group. He is here to present today about how young people can get started in investing and how investing can become more approachable for young people who want to start putting their money somewhere where it will make more money, but really aren't really sure what they're going to get into quite yet. So we're really happy to have him by. He's a recent graduate from the Haskayne School of Business, so a Calgary-based guy. Thanks so much for your time today, Karsten.
Hi, everyone. Thanks for having me. Thanks for taking the time to come and listen. So it's my understanding that this is kind of an introductory seminar on investing for most of you. So I'll do my best to make this kind of come across in an understandable way. So I'll just kind of start with a quick introduction on myself. So like Perry said, I'm a recent graduate from the Haskayne School of Business at the University of Calgary, and I had a concentration in finance. And now I'm beginning a career in wealth management at the Bishop McDonald Advisory Group, which is a wealth management group at Scotiabank. So when Perry reached out and asked me to do this presentation, I reached out to a few friends and I asked them kind of what they would want to know if they went to this presentation. And the first things that I got back, and the majority of what I got back, was that they didn't even really know where to start or what to ask because they didn't know what they didn't know. So I think a good place to start for this would be kind of just a general knowledge base of what investing is, because I realize some of you might not have any prior knowledge at all. And for those of you that do have a little bit of prior knowledge, sorry, this first part might be a little bit boring, but I think it's important to make sure everybody has that base knowledge and is able to kind of understand what's going on. So in general, when people talk about investing, they're talking about putting money into the stock market. And the stock market is pretty much a marketplace where companies sell percentages of ownership of themselves, and individuals within that marketplace buy and sell those percentages of ownership, and those are known as shares or stocks. So a stock is just a percentage of ownership of a company. So the overall stock market is just a big exchange where people buy and sell percentages of ownership of companies. And so here's an example of how this kind of works, just to kind of make it a little more simple. So imagine a company is worth $100 and they're selling ownership of their company, and you buy 1% of that company. So you give them $1. And then for whatever reasons, there's a lot that goes into it, but that company then doubles in value. So it's now worth $200. You still own 1% of that company, so now your $1 has doubled into $2. That's pretty much the basic concept of investing. You put money into companies, those companies hopefully grow in value, so the money that you put in also grows in value. So just a quick little recap, when people talk about investing, they're referring to the stock market for the most part. And the stock market is a marketplace where companies buy and sell ownership of themselves, and individuals buy and sell those percentages of ownership in the companies. So now that we have that kind of basic knowledge of investing, how do you start? So this is something that my friends also kind of asked when I asked them. They don't even know how to start. So the thing that I always tell young people is to open what's called a tax-free savings account, or a TFSA. A TFSA is kind of the holy grail of investing in Canada because, as the name suggests, it's tax-free, which can help a lot when you're investing long-term. And if at the end of your career, you're in a higher tax bracket and you're taking money out, you want to be able to avoid as much tax as possible. And the tax that can come with investing can get pretty large at the end if you've been doing it for a long time. And this is because investments get taxed on the gains they produce. So if you invest $1 and that grows into $2, that extra $1 that you made on your investment will get taxed when you withdraw it. And that doesn't happen with the TFSA, so it's pretty good. So a tax-free savings account is essentially just a savings account like you have connected to your debit card, but its best use is to invest through it. And you can do that through multiple ways. The two big ones are managed and self-directed investment portfolios. So the difference between managed and self-directed is that a managed portfolio, the money you're investing is taken care of by other people, and you don't have to do any of the work. In a self-directed portfolio, you have to do all the research and all the picking of the stocks and everything all by yourself. So both paths have the same goals, but they're just kind of two different ways of getting there. So first, we're going to talk about the managed path. In general, managed portfolios are through banks or wealth management groups. But to start, it's kind of easiest and best to just go through a bank. You can just go into any branch like ATB, Scotiabank, CIBC, all the big ones, and just talk to one of the clerks or an advisor and say, hey, I want to open a Tfsa, I want to start investing. And they'll have a lot of resources to be able to help you. But most likely, they'll start to talk to you about your goals and kind of what you want to have from investing, and then what kind of risk you're willing to take from investing. This is kind of how they determine what they want to invest you in. And then they invest your money into what they think will be best suited to reach your goals in your desired time frame. Each managed portfolio will be a bit different because each bank and each group will have a different outlook on what will help you reach your goals in the best way. This is how I got started investing. My dad and my grandpa always talked about investing that they did, and when I was old enough to understand, they started to teach me the basics. And when I turned 18, they told me the exact same thing I'm telling you now. Go to the bank, tell them you want to start investing, open a Tfsa, and just talk to them about your goals. So for the topic of goals, some people might not know what their goals are when they start investing. So I'll just kind of go over a few of the most common ones. Most people have pretty long-term investment goals. So things like retirement, education savings for their kids, or putting money away for a really long time so that their grandkids won't have to work very hard in their lives. Those are kind of the most general long-term investment goals. But some people also have shorter-term investment goals, like keeping up with student loan payments and putting a down payment on a house, or even something as simple as putting money away for a vacation. It all kind of depends on what stage of life you're in and what your priorities are at that point. And this is something that your advisor will discuss with you when you first go in to start investing. So even if it's a little overwhelming to think about right now, they do a pretty good job of making it a little easier and kind of simple to comprehend what your goals will be. So managed is the way that I suggest most people start investing, because it just gains exposure to investments and it just kind of gets the ball rolling. And there's other people handling it that have been doing it for decades and they really know what they're doing. It's just kind of a safer way to get started. Self-directed, on the other hand, since you're handling it all yourself, it requires a lot more knowledge and it's a lot riskier because it's just you. And there's a lot of things and a lot of ways that can make it go wrong. So you can open up a self-directed portfolio through a bank as well, but the most popular ones are Questrade and Wealthsimple, which I'm sure you've seen a lot of the ads for. So because you pick all the companies and all the ways that you want to invest yourself, there's no guarantee for how it's going to go. So, and I'm sure with self-directed, a lot of you have seen the ads about how there's lower fees and you get so much more control and that'll help you out so much. But lower fees doesn't necessarily mean it's better. With managed portfolios, sure, you do pay slightly higher fees, but you're paying those fees for a reason. The people that you're paying when you pay those fees provide an extra layer of security for your investments. They've been doing it for a long time. It's their career, so they get paid for a reason. And they're usually pretty good at what they do. So sure, with self-directed, you're paying lower fees, but it's a choice of whether you want to pay lower fees and take on a lot more risk and potentially lose a lot more money because you just make a mistake or something goes wrong that you didn't anticipate, or you pay slightly higher fees and you have confidence that the people taking care of your money know what they're doing. They have countless certifications and degrees giving them all this extra knowledge so that they know what is best for your money. So once you've picked which route you kind of want to take, there's going to be a lot of different opinions and things you read or hear on what's happening in the stock market with certain companies. And you'll get a lot of this, especially if you're doing self-directed. That's just kind of the nature of it because you're doing it yourself. So I've just got a couple things to keep in mind as you start investing. don't always try and follow the hype and these trends surrounding certain investments, like the meme stocks that I'm sure some of you have heard about. They're short term, sure, you might make a lot of money. Some people do, a lot of people have, but long term, chasing things like this will only hurt you in the end. And they might look flashy, and you might be able to brag to your friends about making lots of money on GameStop, but it's not really a way to guarantee your investments long term. So I'm actually reading this book right now. I've got it on the screen, A Random Walk Down Wall Street. It was written quite a while ago, and it's revised pretty frequently to current things that are going on in the stock market. And there's an idea in a quote in it that's pretty present throughout the whole book, and I think it applies really well to this idea. So I've got the quote on the screen. It's not hard to make money in the market. What is hard is to avoid the alluring temptation to throw your money away on short, get-rich-quick binges. It's an obvious lesson, but one frequently ignored. I think this applies perfectly to kind of all the stuff you're seeing in the market right now with the meme stocks like GameStop and AMC and now Clover and Wendy's. So it's just something to keep in mind. Another piece of advice for beginning is try not to get caught up in the day-to-day changes of your investments. The stock market moves a lot every day. And so some days you might have your money getting smaller, the value of your investments getting smaller. But it's important to have a long-term vision and realize that as long as your money is being well taken care of and well managed, some short-term losses at the end of the day aren't the end of the world, as long as your long-term goals are still on track. So on the screen here, I've got a chart of the S&P 500 over the last 6 months. So the S&P 500 is kind of the most common measure of general stock market performance. And as you can see in it, there's a lot of pretty big drops, but overall it grew a ton in the last 6 months. So this just kind of shows that even if there's some spots where your investments might lose some value, in general, it's better to push through those times because the long-term performance will outweigh the day-to-day losses. So, okay, I know that's a lot of information, so I'll just take a second to recap. Tax-free savings account is the holy grail of investing in Canada. Use it to open a managed investment account through your bank, or if you're confident and risky enough, you can go self-directed. Try your best not to follow the hype in the market. It's a really easy way to lose a lot of money. And try not to get caught up in the daily changes of your investments. Your long-term goals are more important to think about. So the big question in all of this is, why does it matter? There's two answers to this question. One is pretty complex and the other one's really simple. So I'll go over the complex one first. Investing helps you beat the effects of inflation on the value of your money. So inflation is the decreasing of the value of a currency. If you've ever heard your parents or your grandparents talk about how they used to be able to buy a Coke for 50 cents, but now a Coke is like $2 or $2.50, that's the cause of inflation. So the average annual inflation rate since 1915 is about 3%, which means that the purchasing power of a dollar has decreased by about 3% each year since 1950. If you only had your money in a savings account, the highest interest rate savings account at Scotiabank is about 0.6%. So if your money is growing by 0.6% a year, you decrease that by the value of inflation, your money is actually losing about 2.4% of its value each year. If you had all that money invested, on the other hand, the average annual rate of return of the S&P 500, so the general kind of stock market performance, was 10.9% over the 50-year period between 71 and 2020. If you take the value of inflation away from that, your money would still be growing by an average of 7.9% each year. So all those numbers is just to kind of say, investing protects your money from losing its value over time. So the much simpler way to answer the question of why does it matter is that investing makes your money make you money. So something as simple as going to the bank, getting started investing can make you long-term passive income for almost zero effort. And that sounds like a pretty good deal to me. So this kind of leads me into my next point of why is it important to start young? I hear a lot of people say that they aren't investing because they don't have enough money. And for most people, this just isn't true. Investing isn't just for people that already have money, it can be for anybody. So just think about this kind of idea. A venti latte from Starbucks is $4. If you had one every day for a year, you would spend $1,460 a year on coffee. Now, take that $4 a day and instead of coffee, invest it. And I have a chart a little later that shows how much $4 a day can grow over time when it's invested. But this question of why is it important to start young can be answered by a couple concepts from finance. The first one's called the Rule of 72, which leads into the idea of compounding return. The Rule of 72 is essentially asking the question of how long does it take to double your money? And I won't bore you with the math of how it works, but it's pretty much a measure in finance that people use to see the long-term effects of investments on their money. Now, this directly relates to the idea of compounding return, which is essentially the exponential growth of your money. And I put together a few graphs to kind of show off how much compounding return can affect your investments. So this first graph is the growth of $1,000 invested for 30 years at 10%. So each year your money's growing by 10%. So you start with $1,000, it grows 10%. The next year, that $1,000 plus whatever you earned the year before also grows by 10%. And then just exponentially, it gets bigger and bigger. And at the end of 30 years with zero effort, your $1,000 has turned into almost $16,000. Now, this next graph shows off really why starting early is important. So the blue line is the same as the last graph, but the red line is the same amount of money, $1,000, at the same rate of return, 10%, but it was started 5 years later. So it only grew for 25 years as opposed to 30. And the difference between the final numbers is really what shows you how starting early is important. So just the 5-year difference creates almost a $6,000 difference at the end. And that's just with putting $1,000 in at the beginning and leaving it alone. So think back to the $4 a day saved on Starbucks becomes $1,460. This next graph is $1,000 at the beginning, and each subsequent year putting in $1,000 more, and that really makes the growth take off. So as you can see, it goes from at the end of 30 years being just under $16,000 to being $163,000. So compounding interest is an important thing to keep at the back of your mind when you start investing, because at the beginning, it can kind of feel like your money is growing very slowly and not a lot's happening because you're just kind of at the beginning of that curve. But when you stretch it out and see how that curve really starts to shoot up, it kind of makes you understand why having your money in and keeping it in investments is important for your long-term goals. So it's important to, in that way, to understand what your expectations should be when you're investing. Because if you think that just because you have your money invested, that you'll be rich in a month, like some people do, then it can really lower your motivation and it can really lower your motivation from pushing towards your long-term goals. So obviously this is very surface level information. There's a wealth of information and knowledge about investing that I could never explain to you in such a short period of time. Also because I don't know the half of it. I'm still learning constantly. So this is something you constantly have to continue learning about. And that's kind of what I encourage all of you to do after this, is just keep learning about it. Because when I started my degree and I started to really learn about investing, I just tried to expose myself to as much knowledge as possible. So here I've got some valuable resources that can help you kind of grow your knowledge of investing. Yahoo Finance is a great place to read on specific stocks as well as general market trends and kind of what's going on in the economy. You can add stocks to a watch list and you'll just get notifications about news on those stocks when they come out. So it's really good to just kind of stay current with what's going on. Northern Trust is a team that we work with at my job. They have a great page on their website dedicated to market insights and research that I still use and I read a lot, kind of just to figure out what's happening in the market. And you can get them to email you all their news too, so you're just constantly up to date as well. And kind of what I'm doing now to keep myself learning is I'm reading a lot of books on stock market history and investment theories and techniques. So there's a crazy amount of information out there. And the only way you can really get better at understanding your investments is to learn about it. And it seems intimidating at first, but as long as you kind of expose yourself to the information, you'll start to amaze yourself with how quickly you start to pick up on things and learn about it. Now, I know that this is a lot of information in a short period of time, but if there's one thing you take away from this, it should be just walk into your bank and tell them you want to start investing. They'll be able to give you a lot more specific answers on your situation, but the most important thing is to just get started. So that's kind of what you should take away from this, is just start. Go to your bank and just they'll take you from there. So that's all I really have for today, but feel free to reach out and get in touch with me. I would love to answer any questions and be able to point you in the right direction. This is something that I feel is really important, especially for young people. So I'd be happy to be able to help in any way that I can. And I guess I'll just open up the floor to questions now.
Okay, thank you so much. I have a wealth of questions right now, but I'm going to try and hold myself back because I know my job isn't to push my own agenda right now. But before I address anybody else's questions, I was just wondering, how do you choose which companies to invest in?
So that's a really difficult question to answer because it's all just kind of based on your opinion within the market. And that's just kind of what drives the market in general, is that everybody has their own opinion on whether or not stocks are going to go up or down. So like right now, something that I think, and I just have to clarify, none of this is legal advice or financial advice for legal reasons, but something that I do is for oil and gas stocks, I look at the price of oil and it's really high right now. So just in my brain, that just kind of points me towards, okay, oil prices are really high. Oil stocks will probably get higher. So it's just kind of like a way, you just have to research a lot and just figure out your opinions on what companies are going to go in which directions. There isn't really a clear answer to it, which is kind of what makes it fun.
For sure, it adds that element of risk. For those being like that, it's definitely kind of a fun gamble to do. We'll address some questions now from the Q&A now. So we have, somebody has asked, is there a limit to how much you can add to your Tfsa account?
Yes, so there's a $6,000 limit each year, just because they want to limit how much you can get into it tax-free. But the other kinds of accounts that you can open there's a ton of them. So like RSPs, RESPs, stuff like that. It kind of just depends on your situation, which one you would want to open. So that's something that you would have to talk to an advisor about to figure out.
If you have, I have a follow-up question to that. Can you have more than one TFSA if you have like two bank accounts? Like if you have a bank account with Scotia and with a different bank?
Yes, so you can have multiple TFSAs, but that doesn't expand your contribution limit. So it's $6,000 no matter how many you have, but you can just kind of put that into however many accounts you want.
Okay, that makes sense. We have somebody asking, how do ETFs work? And just on a personal note, what's an ETF?
Yeah, so an ETF is a fund that is built out of a bunch of different stocks that somebody kind of compiles into this single unit. And usually they're built to kind of replicate certain portions of the market. So they just say, okay, I want to make a fund based around tech or like healthcare. And then they just go and pick all these individual stocks and they make this unit fund out of it. And then they break up that fund and they sell units of that ETF. So it just is kind of like a way to track a certain portion of the market or a certain index in the market without having to go out and buy like 80 different units and just have it be one thing in your portfolio.
Okay, and then on the ETFs note, we have somebody asking, if I was looking for a safer investment that could give me a better return, they're currently students, they can't afford to lose too much money. Would ETFs be a good option? And if so, which ones? I think the which ones question is maybe something they need to ask somebody like privately, because again, you can't really give advice today. But if you want to do that off the record, go ahead.
Yeah. If you're looking for something that's relatively low risk, but still gives you good return, market index ETFs are the best thing to do, because they just kind of track the things that all the highest people in finance put together to track the market. So the S&P 500 has a bunch of different ETFs that track it. So any of those will just kind of take you along with the stock market and give you the same return that in general it's getting.
Okay, gotcha. Somebody has asked, which self-directed platform would you recommend? They're with TD and they find it kind of confusing.
I have a Questrade one. Questrade's pretty good. It's pretty simple to navigate. I have a few friends that have Wealthsimple ones. They seem to enjoy them, but those are kind of the two big ones that I would recommend to people if they're going self-directed.
For sure, the ones that are advertised all the time. If anybody watches TSN, it's like nonstop.
Yeah.
Somebody else has asked, a lot of my friends wonder about how dividends work, and as a young investor, is that something they should worry about?
Dividends. So first I'll answer what they are. So a dividend is something that a company pays out to the people that own its stock. So they just take a percentage of your ownership within the stock. So say you have $1,000 in the stock, and then they pay a 1% dividend. Yearly, they'll just give you $10, pretty much. So it's like a way of just earning passive income through investing in companies. And if it's something to worry about while you're young, I'd say it's not crucial. It's not something that you should be seeking out, because passive income is more of something that you worry about when you're investing later in your life, kind of when you're in the retirement stage and you kind of need to get some sort of passive income because you're not working anymore. That's kind of more where it is important, but it's not bad. It's always good to have more money coming in. So, yeah.
Follow-up question. If the company's stock price decreases, would you ever get a negative dividend?
No, you can't get a negative dividend, but they can cancel their dividend. So when companies are kind of starting to fail or they're having issues within themselves, they can cancel their dividend and not have to pay it out that year. So that's what a lot of companies do when they're trying to save money, is they stop paying their shareholders.
Okay, gotcha. We have another question. What is the difference between stocks and bonds?
Okay, so stocks are percentages of ownership in companies, and bonds are essentially debt that companies issue, and governments also issue bonds. So it's, you give whatever thing is issuing the bond a set amount of money, and then they pay it back to you over a set period of time through interest payments and a lump sum payment at the end. So it's like if you're paying down your debt on your house, but they are paying you.
Okay. We have another, is there a limit to how much I can withdraw from a TFSA?
I don't believe so. I think you can just take it all out whenever you want.
Okay, that would make sense. And then another one is, which books would you recommend for beginner investors?
So the one that I'm reading now, A Random Walk Down Wall Street, is really good. It does a really good job of explaining things in relatively simple terms. It can get a little bit much at times, but it does a really good job of relating investments to things that are more easily comprehensible. And it goes through a lot of history within the stock market, and it talks about how history tends to repeat itself a lot, which I find is really interesting. And then if you want to get more into the technical side of it, there's a book that I want to read actually called The Man Who Solved the Market. It's about Jim Simons. He was a person that kind of launched the revolution into quants, which is kind of like the really hard numbers side of investing. So that would be a good one for the technical side of it.
Perfect. Okay, varying levels of expertise based on how deep you want to go into this.
Yeah.
We have somebody else who has asked, can you transfer your stocks from one platform to another?
Yes. So it's a little bit complicated, and that's something that you would have to talk to your advisor about, but you can transfer ownership of a stock from one portfolio to another. You don't have to sell it and then buy it again. You can just move it over.
Okay, so it's just from going from platform to platform. We have one more: technical analysis or fundamental analysis, or both?
I am a proponent of both. So technical analysis is kind of like you're looking at charts and graphs of stocks and seeing how trends that have happened before kind of repeat and influence trends happening in the future, completely based on price of the stock. And I think that can kind of point you in the right direction at certain times. But I also think fundamental analysis is just inherently important, because fundamental analysis is essentially looking at the true value of a company and how it relates to the price of the stock. And that's kind of something that's a bit of a mess right now in the stock market, because there's certain companies that the stock price is so inflated that it doesn't even relate to the true value of the company. But technical analysis would lead you to believe that the stock price should be even higher. So it's kind of something that you have to take both into account and just kind of gauge what the market is saying about that stock. And kind of to add another point onto that, that kind of relates to technical analysis, is behavioral analysis is something that I find really interesting. And that's kind of just the psychology of how people invest and what kind of influences people to like or not like certain stocks or investments. So that's something that I also kind of take into account when I'm thinking about a stock.
Excellent. Thank you so much, Karsten.